This is your technical update from the LMAX Exchange Research and Analytics Desk for Friday, February 6, 2015. Euro dollar. So the market continues with its correction off the recent 11-year lows at 10.98, and this correction is poised to continue if the market can break above 15.34 on Friday. A break and close above 15.34 would open the door for the next upside extension towards 17.50 further up. At that point, there is the possibility for the formation of a lower top and bearish resumption, and ultimately only back above the 50-day moving average would compromise the current bearish structure. But again, there is risk for additional correction above 1535 towards 1750. Of course, if the market stalls out and is unable to successfully establish above 1535, a break back below 113 would do the job of putting the pressure back on the downside for a focus and retest on that recent 1098 low. Cable. So cable is starting to get a little bit more interesting after a period of several days, multi-day consolidation, roughly between 49.50 and 52.70. The market has finally decided to break that range to the upside, and this opens the door for additional corrective activity into previous support at 54.85 and then towards 56. So the 154.85, 156 area is that likely next zone where the market will look to put in a fresh lower top ahead of a bearish continuation. Ultimately, despite the gains, the market is still locked within an intense and well-defined downtrend, and really only back above the 58.25 area would compromise that structure. Dollar yen. So dollar yen continues with its consolidation after posting fresh 7-year highs in December. The market for much of 2015 has been locked within a contraction, a range contraction, and the contraction continues with the market now reaching the apex of this triangulation. And so this suggests that the market could soon be poised for a breakout and a pickup in volatility. Of course, you want to pay attention to these key levels at 21.85 and 15.55 above and below, but more sort of short term, if the market can take out this range resistance here, break back above the 118.50 area, or break below, let's call it 115.75, or the recent low at 115.85, that will open the door for a potential break and suggest that the market is poised for its next extension. A break below 115.55 would open the door for fresh downside in this market, potentially exposing the 110 area on a measured move off of the consolidation over the past couple of months. Although if we do see that pullback, the uptrend is still firmly intact, and a medium-term higher low would be sought out somewhere around or ahead of 110. A break to the upside above 119 and then through 120, 185 would open the next upside extension and a bullish continuation towards the 125 area. Euro Swiss. So Euro Swiss continues with its bullish consolidation since breaking out of a range above 102.50. The key focus is a measured move target at 107 further up, and the market is expected to sort of push towards this level over the coming sessions. Ultimately, any setbacks now should be very well supported by that previous resistance at 102.50. Aussie dollar. So Aussie dollar has entered a period of correction following its break to fresh multi-year lows down at 76.25. The recent push back above resistance at 78.50 now suggests that the market could be forming a double bottom and a correction higher back towards the 80-50 area in favor of the next lower top and a bearish resumption. But ultimately, given overextended technical studies and the recent declines, it is possible that the market does enter this period of correction higher before we see a resumption of declines. Of course, a break back below recent support at 77.30 would suggest that the market is ready for a more immediate bearish resumption. Dollar CAD. Dollar CAD has been correcting this week after posting fresh multi-year highs at 128 last week, and this correction could still have room to continue with setbacks seen potentially down towards the 20-day moving average, which comes in around 123. However, again, the uptrend remains firmly intact, and it's just a question of where this market looks to put in a higher low ahead of a bullish continuation through the high at 128 and towards the 2009 peak at 130.65. Kiwi dollar. Kiwi dollar is also entering a period of correction after breaking down to its fresh multi-year lows, about a 4-year low for Kiwi. The market had traded down to 71.75 ahead of this latest bounce, and it is possible again that this correction continues higher back towards some previous support in the 76 area, where a lower top would be sought out ahead of a bearish resumption. Ultimately, any rally should be very well capped by that previous support at 76, and really only back above 80.35 would compromise the bearish outlook for Kiwi. S&P 500. The SPX 500 continues to chop around. The market has been showing signs of the potential for a topping formation, but will need to stay below 2070 on a close basis to keep that outlook intact. A break back below the recent low at 2025 would put the pressure back on the downside, and the focus on that key support at 1968, the low from the December 16th further down. A break below 1968 would then expose the October base at 1820 and confirm that topping outlook. Of course, if the market is able to break back above 2070 and establish above 2070, it'll put the focus immediately on the record high from late December at 2093, and then for a push above 2100. Oil. So oil has been a little bit interesting this week after its declines over the past several months. The market trading down all the way to 43.55 is finally showing signs of some form of a base, with the price pushing back above that key high from the 15th of January at 51.25. The push above 51.25 now opens the door for additional corrective activity in oil towards the peak that we saw, or the consolidation highs back from December 18th at 59. Ultimately, a break above 59 would be required to force a bit of a shift in the structure, but again, there is risk for additional corrective upside towards 59 before this market considers a bearish resumption. Of course, if the market fails to break higher and pushes back or drops back below 47.35, this will put the pressure back on the recent lows at 43.55, which defend and guard against the barrier at 40 further down. That's all for today.